When we look back at the history of Rome, there's one detail that often gets overlooked. The empire didn't just collapse because of wars or political conspiracies, it collapsed because of lost trust. The silver denarius was once a symbol of stability. People didn't just see a coin, they saw the strength and the promise of the empire. But when emperors began diluting the silver, the coins grew lighter, their shine faded, and with each cut in real value, the trust of the people eroded. When they no longer trusted the coin, they no longer trusted Rome. In today's startup world, your currency is trust. The trust of investors, employees, customers. Investors don't put money behind a deck of slides. They invest because they believe you can turn ideas into real value. But once that trust wavers, when promises don't match results, when growth is just smoke and mirrors, fundraising becomes nearly impossible. You can run out of money and rebuild. But when you run out of trust, the game is over. Because money, whether ancient silver or modern venture capital, is only a mirror of belief. And belief is fragile. It can't be printed, it can't be faked. It has to be earned slowly through transparency, consistency, and real value. The lesson Rome left us is clear. The most valuable capital isn't money, it's trust. In ancient Rome, when the denarius lost value, the real survivors weren't the ones hoarding coins. They were the ones with land, with food, with skills. Because money is just a symbol, but real value lies in what sustains life and creates surplus. Land was still land. Wheat still fed families, and skilled hands could always trade work for what was needed. Look at startups today. You can raise money, inflate valuations, and project an image of expansion. But without a product that truly serves people, without loyal customers, without the ability to actually build and innovate, it's just a thin shell. And when crisis hits, that shell shatters instantly. Core value isn't the number on paper or the noise of a funding round. It's the product that brings customers back again and again. It's the team capable of building solutions no one else can. It's the intellectual property, the processes, the technology, assets no one can strip away. Rome's lesson still stands. Money is only a tool of exchange. The foundation is what you create and sustain. Only startups that grasp this truth can weather the storms. One of Rome's biggest mistakes was believing prosperity could be printed. They issued more denarii, but the coins were hollow, stripped of real worth. The result was runaway inflation, shattered trust, and an economy torn apart from within. Today, many companies, especially startups, fall into the same trap: the illusion of growth. More funding rounds, more hires, more ads, bigger offices. On the surface, it looks like success. But without actual profits, without proof of core value, those moves are nothing more than Rome's inflated coins. Temporary survival at the cost of deeper collapse. Think of it this way. Raising round after round without fixing the business model is like breathing through an oxygen mask. It might keep you alive for a while, but it can't replace healthy lungs. At some point, investors will pull the plug and force the startup to face reality. The lesson is simple. Growth only matters if it's sustainable, built on real value, real customers, real revenue. Illusions can stretch for a time, but when the bubble bursts, the cost is always far greater than building a foundation from the start. We often think Rome fell to barbarian invasions. The truth is harsher. Rome rotted from within long before the enemy arrived. Devalued money, crumbling trust, crushing taxes, abandoned farms, deserted markets. Once the economic spine was broken, even a light push from outside toppled the empire. In business, the greatest threat often isn't competition. It's internal collapse. A company can fear rivals in the market, but the real killers are negative cash flow, bloated costs, weak leadership, fractured culture. When the inside is broken, even the smallest shock from outside can bring everything down. Picture a startup facing copycats. If its finances are sound, its team aligned, its model solid, it can fight back. But if it's bleeding money, losing talent, mismanaged, then that competitor's move is just the final blow. Rome's reminder: don't obsess over external enemies while ignoring internal decay. Internal crises, left untreated, are deadlier than any outside rival. Strength starts within. Many believe inflation is just an accident, like a storm passing through. But history shows inflation is often deliberate policy. Roman emperors didn't accidentally strip silver from the denarius. They did it to fund armies, projects, wars. Every new coin delayed collapse, but also sliced deeper into public trust. In startups, this is just like dilution. A company can raise round after round, but every round divides the pie thinner. Founders slowly lose control. Investors eventually realize that value isn't keeping pace with new shares. Imagine a founder once holding 80% of the company, after several rounds down to less than 20%. Control slips, investor trust shakes, chaos brews. Like Rome, they traded belief for borrowed time and lost both. The truth is clear. Inflation and dilution aren't accidents. They're choices. And if abused, the cost isn't just numbers on a balance sheet. It's the collapse of trust, the most precious asset. In 301 AD, Emperor Diocletian issued a sweeping decree. Fixed prices for over 1,000 goods and services: bread, wine, wages. His goal was simple: stop inflation, stabilize the economy. The result? People ignored the price list, black markets thrived, official trade broke down. No mandate could rescue a currency already stripped of value. In startups, this mirrors burning money to buy market share. Many founders, instead of fixing weak products or shaky models, pour millions into ads and discounts. On the surface, growth. But underneath, the sickness remains. When the cash dries up, so does the market share, leaving a void even larger than before. Think about it. You can buy app downloads with 50% discounts, but will users return once the promotion ends? Just like Rome, you can impose prices, but you can't impose trust in a worthless coin. Short-term fixes buy time, but only real value keeps the market. The lesson? Quick fixes fail. Only strong products and sound models sustain. In 1923 Germany, a loaf of bread cost billions of marks. People pushed wheelbarrows of cash just to eat. That was Weimar hyperinflation, born from printing money recklessly to cover deficits. The mark collapsed, trust vanished, society trembled. Decades later, Zimbabwe replayed the story. Printing presses roared until $100 trillion notes circulated, worthless except as souvenirs. Citizens abandoned their own money for dollars and gold. Even the U.S. has felt inflation's sting. In the 1970s, oil shocks drove prices, unemployment, and interest rates sky high. Only disciplined, painful reforms pulled the dollar back from the brink. Startups today? The same principle applies. Undisciplined capital burns, endless fundraising to patch holes instead of creating value. It's a recipe for collapse. Whether through monetary inflation or equity dilution, the rule is the same. Lose financial discipline, lose trust. And without trust, there's no future. I once met a young founder. He raised round after round, but the product didn't improve, customers didn't stick, revenues stayed flat. He said, "We just need a little more funding to survive a few more quarters." Then we'll figure out growth sound familiar? It's Rome all over again, printing coins to survive while digging its own grave. Raising capital isn't wrong. The real question is, why are you raising? If just to survive, you'll be trapped in a cycle. Raise to sustain, sustain just to raise again. Eventually, investors walk away because they see no lasting story. But the successful founders, they treat capital as fuel, not oxygen. They know exactly where it goes, expanding markets, refining products, deepening customer loyalty. That's how they build something real, something investors want to stay with. A mentor once told me, "Capital is like fire. Use it for warmth and it burns out fast. Use it to forge steel and you build a sword." Smart startups don't raise to survive today. They raise to create the foundation for tomorrow.